have the opportunity to be the trusted custodian in customers' lives.
63% of the industry's value growth in the last decade was captured by non-incumbents.
The danger is that the banks will just drift into being the dumb balance sheet in the future of the industry.
And what we need to move towards is a mode of convenience.
Crucial thing is build for the financial lives of the customers that you actually have.
If you leave it to the long arc of time, stable coins and CBDCs and other things will sort of take over and you'll lose control, of that, because they're essentially being run by private companies right now.
You spend more time focused on keeping customers on your platform, making the platform more efficient, pursuing bad profits, than asking the question, what role can I play in this digital future of our customers, embracing the technology that's coming? Or do I just outsource all of that? If you can empathize even before you've had them, you're on the path to being able to develop services that are financial life partner services.
Yeah, and I think that's beautifully said. Welcome back to A to Z FinTech. I'm Aman Narayan, coming to you from a relatively humid Singapore. Zubin's taking a break on this one. I've got the keys to the studio for an episode that has honestly been years in the making. Today is a full circle moment. My guest is someone who gave me my first break into digital banking years ago at Standard Chartered. He's an award-winning FS executive, a man who knows how to take the terrifying, complex banking strategies of this world and make them just beautifully simple. Alistair Campbell's here. He's the former strategy head of NatWest, a veteran of Marathon. I should say the only consultancy that's given me more friends than PowerPoints. He's just written what I believe is a really provocative book called Healthy Money. Al, we've discussed the genesis of this book many times. Most recently, last summer at Soho House, it was inspired by your 35-year friendship with Richard Kibble, your best man and Deloitte's banking strategy lead. Richard's sitting this one out, so it's just you and me. Welcome to the show.
Aman, thank you. It's a pleasure to be here. We, as you say, you and I go back a long way, and you're on every page of this book, so I really appreciate the chance to talk about it with you.
That's very kind. Let's start with the sort of core question for anybody who sort of picks up this book that I have a copy here. What is healthy money? Is healthy money about how people should be living their lives and their relationship with money? Or is it healthy money about banks and how they should be building products for customers?
Yeah. Thanks, Aman. It's a little bit of the former and a lot of the latter. So I felt, and we've talked in the past, there are thousands of books out there telling people how to run their financial lives a bit better. And there are quite a few books telling banks how to use digital transformation better. But really, there really aren't that many books about how banks can use digital transformation to create services that help people run their financial lives better. That's what this book is primarily about. Obviously, it gets into how people need to run their lives better, but it's really about the banking services that are missing and the technology that can make that difference.
So we wouldn't be good bankers or former bankers if we didn't sort of go straight to the data.
Yeah.
Just that your data shows that 63% of the industry's value growth in the last decade was captured by non-incumbents.
Yeah.
Why?
Well, in some respects, that's because they have digital scale, global digital scale, but that's combined with real customer relevance. I mean, I don't think the kind of direct competition that banks are getting from Stripe, from Adyen, or the marginally indirect competition they're getting from Amazon or Shopify or places like that, or the Apple Wallet, that wouldn't be happening if customer needs for a healthy financial life were being really well served by the incumbents. It's that headroom of unmet needs that is meaning that most of the growth actually is going on outside of the incumbent sector.
And when you talk about value, do you talk about, you measuring it in market cap, in revenue growth?
Yes, that's a market capitalization. That's a direct comparison to what happened, I think, in the TMT sector, where the telcos were, and that's an exact analogy. They developed 3G, 4G, 5G, incredible technology, but actually the value growth went to the front-end players, the Googles, the Facebooks, who were...
That's what you call, I think, but you call that the dumb balance sheet, right?
Telcos
have always been worried about the dumb pipes.
Right. And the danger is the same thing, that the banks will become a balance sheet that provides services to those front ends, but the value growth is already going on outside of those balance sheets. And just one more point, because often bankers, when they point out about the role of the as balance sheet players, they point out how difficult it is to run a balance sheet and to manage risk. Well, it is difficult. It's really hard to run a 3G, 4G, or 5G mobile phone network, a global network. That's a really complicated thing. Just because it's complicated doesn't mean that it will sustain the value growth that the other players may exploit from it.
And I seem to remember you said 40% of UK customers, I'm one of them, now hold an account with a digital bank. Is that just because the apps are prettier, or to quote Steve Jobs from way back when, it just works?
Yeah, well, I think it's actually that they're not. In the past, people worried that people were going to leave their incumbent bank and move to a digital only bank. That's not what we observe happening. What customers are doing is they're adding a digital bank into their lives. They've got an account with NatWest and they're adding Starling or a Revolut. And they're adding it because specific parts of their financial life are not well covered by the incumbent. It's often a kid's account, or it's foreign currency management, or it's paying bills, or it's a worker, it's a business account. There's specific things that mean that people are now being multi-banked. And it's a statement that the incumbents aren't providing them with all the needs, all they need.
And having worked, I think you and I have worked with incumbents as well as neobanks, and the common, and most recently having worked with the incumbent, I found that the common response was, one of sort of, but they don't really have, your main relationship is with us. The money and the assets are with us. You just use them as a transactional bank. There's a bit of a question sort of framed as a statement. But it's the challenge around that is that, some of these banks, you're in the UK, some of these banks, like the Monzos, etc., have been around for over 10 years. So at some stage, do you see that they sort of, and the product suite is growing, at some stage the customer sort of starts to trust the bank, and it's not going away. It's not a fly-by-night. It's been regulated for 10 years,
Well, yeah. So 2 points on that. The first point I'd make is on your 40% number. Remember, it's 40%, and it was 40% when I was writing in 2024. It was less than 20% 5 years before that. And it's been growing to the point where I think probably now, maybe more than half of customers already have a digital-only account as well in the UK. And I'm told like 85% of people in Ireland do, and things like that. So there's a massive mushrooming. And then I think to the point, Aman, which is, revolution happens slowly and then quickly. This has been a slow transition as customers get comfortable using these other accounts for parts of their life. But okay, then I might just drop my payroll in for a couple of months because I need a big money spend, and then why would I move it back again? And I'll customers won't switch away; they'll drift away from the incumbents.
Yeah.
The other problem, of course, is that once I've become multi-banked as a customer, I've laid myself incredibly open to another player coming in like a digital wallet, heaven knows, like Apple Wallet, and reaggregating at the next level up. And then, the challenge you have as an incumbent bank with your little mobile app in the App Store is why would a customer ever go past the Apple Wallet and open your app when they can get all the services, including yours, in the Apple Wallet?
Yeah, I want to come back to embedded banking. It's very close to my heart, having done that at Google and then at HSBC. I think if we change tracks a little bit, it wouldn't be a book by a strategist if it didn't have a framework in it. You talk about these three wheels of transformation: customers, architecture, and leadership. So, couple of questions. Why these three? Surely there were other candidates. What about things like regulation or capital?
Yeah. Well, on the other ones, I think things like regulation, particularly in the UK, we have consumer duty as a movement now. Ironically, regulators, in some respects, have the same dilemmas banks have. They have prudential regulation on the one hand, but they have conduct regulation on the other hand, and they have competition regulation. And all three of them are trying to march forward. So in a sense, the customer and architectural challenges are reflective in regulation. But the reason why I picked these three, and the we've discussed before, is they're mutually reinforcing they are all levers that the bank has themselves. What do we offer customers? How do we architect? And how do we lead? They're nothing to do with outsiders like regulators or competitors. They are ourselves. And the challenge for us is if you if you try to change any one of them, taking the other two as given, you miss the opportunity. And within banks, that often is happening at the same time. There are people in the businesses who are trying to offer new things to customers, taking the architecture from the IT function as a given. And there's people in the tech function who are trying to, migrate to a real-time core or something, taking the customer propositions of the retail business as a given. And when they do that, they both lose. It's only when you say, actually, we could serve our customers massively better in terms of their financial lives if we had a different architecture. And then we need a different leadership model to drive those. So it's three mutually reinforcing changes.
Okay. When just doubling down on leadership for a second, the primer to that is motivation, Al. Do you think that leadership in banks is often addicted? And I use the word there very deliberately, not because they want to, but they're addicted to unhealthy money, if you like, overdraft fees, lazy balances. It's almost like that's a blueprint for actually, for short-term P&L.
And
having
I definitely think that's true, Aman. And I think, obviously, it's a back book oriented mentality, isn't it? The book that I have and how I make money out of the book that I have is my primary source of income. And that in turn means it's an inertia view of customers. Customers have inertia. Moving bank accounts is difficult. Changing my financial relationships is difficult. Ensuring that I get more money out of the customers that I have, that's the best way to make money.
Do you think that's related to? Do you think that's related to the velocity of movement of management teams? I was talking to, I'll keep him anonymous, but a senior McKinsey director, and he said that he was talking about sort of the correlation between CEO tenure and success, right? I mean, you look at Jamie Dimon today at JP Morgan and their outsized returns. Here in Asia, we've had Piyush Gupta just retire a year ago with an incredible record. These folks have been around for, decades. Tech has had that. Tech has had Tim Cook. We're talking about Tim Cook retiring. We're talking about his retirement in years, right? Whereas banks sort of have a revolving door of leadership and then the layers below them. Do you think, how big of a factor is that in this?
Yeah, I think that's huge. I think that combined with our not a very tech-oriented attitude of senior general managers. So to your point, the examples you give are the tinder spot that light up the reality. Those are two individuals. Is a great example of somebody who was very architecturally driven, and he was working at architectural change cycles, and he had a team around him who understood that they were transforming the architecture, not just the technical architecture, the logical architecture of the bank, and that was going to drive the headroom for customer improvement. And you're right, that doesn't happen in a week or a month or a 2.5 year tenure, but it's a legacy that you leave. Now, of course, you can take a 10-year legacy mindset about a 2-year journey if you articulate your journey as, I'm going to leave behind an architecture better than the one I found, and that's going to be how I'm going to create my own legacy. But you're right, failing that, you've got to be around for 10 years to see the perspective of saying, we are constrained by an account and workflow generated architecture.
I was interviewing for a role a couple of years ago, and I was counseled, when I was talking to HSBC, but not HSBC, somebody else. And I was talking to them about saying that, true transformation, in my opinion, takes 6 to 10 years. And the headhunter stopped me and said, can you please break it down into 2-year chunks? Because you're not going to get the job. I didn't get the job.
There you go.
I presume that
at least.
Yeah. You and I have a habit of being honest and getting into trouble for that. Al, you talk about archetypes. I think one of the really interesting parts of the book is the archetypes that you sort of flesh out in this. And one of them that I loved reading about was you argue that the nuclear family, that sort of model of banking, is dead. Let's dive into the digital native as well. Sort of these people are getting digital pocket money at the age of 11. Could you just sort of paint us this?
So obviously, you and I have both worked at lots of banks where the segmentation scheme is basically a life stage segmentation scheme.
Yeah.
You find people by their life stage and they go through their life stage. And candidly, the people that did that imagine that the consumers is relatively like themselves. The people inside the banks earn quite a lot of money, and they have quite a relatively stable lifestyle and a relatively stable income, and that they assume everybody else is an edge case relative to that. One of the things, and I think this is a conversation you and I had over many years, one of the things that I think was a starting point for this whole movement was when I was working at Singtel and I saw the unbanked and how it wasn't the banking sector that was really being progressive about the unbanked. It was the mobile phone companies that realized. And when you looked at the unbanked, they didn't reproduce the banking products in an unbanked way. They produced products that were much more directly related to their lives. So one of the things the book tries to do is it says, let's not do life stage segmentation. Let's look at people who are not well served by the standard product banking set. And of course, as you say, there's nearly everybody.
Yeah, I want to just just validate something, for anybody listening. Having worked with you for, I don't know, longer than 2 decades, you've been talking about this long before it became popular, right? Where there was first the whole baby boomer idea of segmentation, then came this sort of like dream of segment of one, and you and I have probably produced a lot of decks to justify a segment of one, not believing in that. Truth is actually segment is not based on just purely demographic. It is also based on behavioral trends, and I saw this in Google. We were trying to segment launching Google Pay into shops, like the B2B version in India. It's now at over 200 million shops, so it kind of worked, the segmentation there. But the segmentation was not like turnover of X to Y and A to B or whatever, right? The segmentation was something, it went on the lines of like shop without door and air conditioner, shop with door, no air conditioner, shop with door and air conditioner, then upwards, right? So that was that was more telling of the behavioral elements of that. And that led to Google Pay didn't invent this, another one invented it. So, if you were at a corner store, the biggest problem you had is that you couldn't validate the payment with your greasy hands. If you were making, pans, which is sort of beetle nut thing on the side, you can't like make a pan, use your phone. Your phone's like your Ferrari. So somebody, Paytm, actually created a voice box. So it just said, 2 rupees credited to your account. So you didn't have to actually check your phone. You just got that. Yeah. That was a result of that segmentation. A bank would have never done that. But like a turnover of under 4,000 rupees needs to have a solution like that.
And it's a really good example, because I think what it does is it says, actually, the best innovation comes not from trying to do better for the average and the norm. Look at the weak signals from the people who are struggling with your product and your service, and innovate for them, because they will actually be the best way to innovate back for the core. And I think that's what some of the archetypes do. So diving into a couple of them as an example, to your point. The modern family point was a point that said, right now banks operate as if people leave school, get one job, get one house, marry once, have one set of kids, work through their career, retire and die. That all, everything works very well.
You've almost done all of those things except for the last. Well, not the die part. I mean, the retire.
That makes me an exception, unfortunately. But but the reality is that in the UK now, the average person has not 2 jobs per career as they did in 97. They have 12.
Yeah.
Over half.
Sometimes at the same time. Yeah.
Yeah, exactly. Yeah. Still none of them pay. But that's another good point, which is over 40% of people in the UK have a paid side hustle in addition to their full-time employment.
Yeah.
Over half of the children in the UK are living in a household that doesn't include both biological parents. The modern family is a blended family of multi-marriages, of complex financial relationships, whatever. And then we say, okay, we have a single account or a married person's account. Those are your options. Well, none of them apply to any of those people, to any of the people who are also gig workers on the side, who have modern precarious incomes. So I think actually start with the modern family, look at how they are so networked in a complex, evolving network life, and ask how you would support people in that life having their financial arrangements. Then just one more point. Can I just jump to your digital neighbors point? Which was At the moment, the average kid, certainly in the UK, and I think this is true in lots of countries, it's their first mobile phone at the age of 10. 70% of them want their pocket money digitally. Legally, they can't have a full bank account till they're 18. I mean, so we've got this insane gap between they want digital money.
Can't you have you could have a card at 16 in some places.
Yeah. So you can borrow.
Like Revolut's done that, right? Revolut's
well, that's what everybody's doing. Is they're literally, but people like Revolut designed their system to have parent-child relationships as a core part.
I use that here in Singapore.
For nearly any incumbent is a workaround against the core banking platform that only has accounts that are either single or dual, as opposed to everybody has financial relationships. Somebody invented data graphs 20 years ago.
Yes.
But banks are not using those data graphs to actually describe people's real financial lives. Shock news. People, therefore, having to go to Revolut and Starling and places like that if they want to manage their family.
And, to your point in healthy money, so lots of things to bounce off there. But to your point in healthy money, I've got a 12-year-old and a 10-year-old. And, I was talking to somebody who has a 16-year-old. And they were talking about how they had sort of not got very healthy money behaviors, partly because they don't have the tools, right? So I want to give my kids their pocket money in their bank account. I want them to feel the sort of track. I trust my kids to do the right thing. The sooner they have the ability to do that, the better. Growing up in India, there's a group of people called Gujaratis. My brother-in-law is one of them. They start, informally teaching their kids on how to trade equities. By the time you have a bunch of friends of mine who started learning how to trade equities at 12. And not day trade, but take a position, hold the position. Those kind of behaviors create long-term healthy relationships long before you go to college and you're sort of spending all your beer money and taking out overdrafts, right?
Yeah. And definitely true. One of the points that we've made, you and I have talked about for a long time, and it's reflected in the book, is this point of saying banking is boring, and banks think banking is boring. And banks act like customers think banking is boring, and banking is boring, right? But my money is not boring. My money and my financial health are incredibly emotional character. After my physical health, my financial health will cause me the most extreme emotions I have in my life. It will cause, mental breakdown, divorce, all kinds of sources of stress. It's an incredibly emotional and engaging category, but it's my money that's engaging, not your bank. And I think if you can't mirror my financial life in the way that you architect your services, it's not surprising that I think you're boring and you think you're boring.
So let's go into that. How do you suggest that banks go about that? I have been doing this for, 100 years in one way. How do I, pirouette to this new world that you're talking about?
So I think back to where we started, I think there's three transitions: a customer, an architectural, and a leadership transition. Let me start with the architectural part first, just to make a couple of points. The first is that I think, and these are things that I think the industry is trying to do at different paces in different ways. The first is that the historic core was dominated by the concept of accounts. An account is something where it tells me what a customer owes the bank or what the bank owes the customer. But it's very poor at then articulate, and the treasury function needs to know exactly that, right, in order to be prudential. But it's very poor defining my relationship as a customer with anybody other than the bank. It can't describe my family relationships. It can't describe my work relationships. And so what we need to do is we need to break apart the system of record, the part of the bank that records who owes the bank money and who the bank owes money to, from two things: the products and the customer management. And on the products, there are already technologies well advanced on loosely coupled product design. So you create products that are modular in design and reproducible. And, smart contracts is one term of art for that. And there's different ways of doing it. But I think, therefore, all products ultimately should be fungible and hybrid. Why I need a credit card rather than a fungible credit line? Why aren't all mortgages some form of offset mortgage? Why aren't all savings some form of FIFO savings? Why is it the case that the balance sheet implications of the product are so dominant to the customer that the customer is constrained with a distinction between a current account and a savings account, and a mortgage and a credit card, and all these different distinctions because the products aren't designed at that fundamental level. But once that's happened, ironically, I think what would happen is there would be many more products. The customers would probably actually see fewer products, They would just see more fungibility in their products, but products would become less important. And what would really matter is the customer. And I think that there are 3 customer graphs that don't exist today that really need to exist. My credentials and verifications.
Yeah.
So one thing a bank does incredibly expensively is it verifies who I am and it verifies my creditworthiness. And when we look at the unbanked, the reason why the majority of people on earth were unbanked for many years was because the cost of doing those verifications was just prohibitive. The bank does that and then throws it away. That's an incredibly valuable piece of information for the customer and themselves. It's their digital footprint, their digital passport, their digital financial. So that's the first thing, verification. The second thing is my relationships, my financial relationships. Could I describe a graph that says, I'm the parent of these children, I'm the spouse of this person, I have these gig relationships, I have these side hustle relationships, I have these supplier and customer relationships. And therefore I can control those relationships. You and I can go to the pub, we can pull $20 and we can spend it out of this out of a pooled pot.
Like a pool, a whip,
But all of those sort of things. I can do a whip round at work. I can go on a stag do with a group of mates. All of that is normal. That's how people normally run their lives. Financial interactions are interactions. And the fact we can't do that is nuts. And then the third one is my financial habits. I need a graph of my financial habits. I need to be able to understand my financial habits, and the bank needs to be able to intervene and help me become more disciplined, self-actualizing, and self-discovering about how I can run my financial life in a more disciplined and resilient way. But those 3 graphs strike me as the future of...
So there's credentials, there's relationships, and their habits. Got it. And where there's lots of questions on the back of that, I want to point out something and then jump to the question. One of the things that I've been obsessed about is the fact that the entire construct of a consumer bank is sort of 50 years old or thereabouts, right? It's it goes back to John Reed from Citigroup, sort of articulating it. There's a beautiful note called Memo from the Beach, which he wrote, which is, I don't know if I've shared that with you. It's incredible. It's a clairvoyant view of data and finances from 50 years ago. And he talked, the concept of an individual has changed. You talked about it. Work has changed because you no longer have one. If you work at a bank, you have one employer because legally you can't work anywhere else, etc. Going back to your point on bankers being really bad at designing products because they're an exception. But also as an individual, as you talked about, you've always had relationships. Banks have not really understood those relationships. I lost my dad last month, and my mom, is going through 2 sorts of, trauma. One is obviously dealing with loss of my dad, but the other is the bloody burden of financial jittery poker, sort of like, oh my God, you died.
Coming at you at a moment when you're least emotionally prepared to do all that nonsense.
Yeah, it's unbelievable. It's unbelievable what we had to do. Another podcast. But my point around this is that how do we construct like these individual relationships? And so do you have core banking? How do you see this in the tech stack of this?
Working out.
Banking becomes smaller. What happens to the middle part of this? And then, the front end's changing because as you and I talked about that you may not own the user experience. The user experience may be owned by Google, but the sort of end-to-end experience is owned by you.
Yeah, so I do agree with you. I think it is modular, but it's layered, to your point. So there's a system of record at the bottom.
Yeah.
Historically, the core banking platform has been doing far too many things in a bank.
Agreed.
So what it needs to be is a system of record, and that the GLs run off the system of record. And what we mean by system of record is very specifically who owes the bank what, and what the bank owes to whom, at all points of time, rigid, clear, and that's the thing. Above that, I think there's a product engine. There is a thing that generates products, and it has modular components, that interest rate calculators, hybrid product designs, whatever. It reuses the scripts across, and then if you want to adapt a repayment scheme, or if you want to do an offset mortgage, if you want to do a FIFO savings product, anything that you want to do is just a reusing of these components decoupled from the system record below. Then I think above it, I think you're right. I think there are then these 3 graphs, and they're all powered by a common event streaming and event history.
Yes.
What's the history of my data proofs that creates my my credentials? What's the history of my setting up of relationships that creates my relationship graph? And what's the history of my behaviors that creates my habit graph? Those three tools. And then above it is all the experience layers, as you say, the touch points. And I believe that incumbent banks have the opportunity to be the trusted custodian of that piece in customers' lives. I think that's the thing that, the trust relationship between banks and their customers is less just about the prudential piece. It is about this potential to be the trusted custodian of my credentials, my relationships, and my networks. And I only really want to do that. I don't want to have that in 10 different places. I can have 10 different experiences driving off of that.
Yeah.
But this is actually, and so in the past, banks thought that they had a sticky relationship with their customers because it was inertia. Frankly, it was a pain in the ass to move banks. The future may be a sticky relationship with my customer data. That actually could, but it's a very specific concept of customer data, not, my marketing preferences.
Yeah, so I call it a moat of convenience. So what banks have trapped you in is a moat of inconvenience. And what we need to move towards is a mode of convenience, saying that actually it is, I keep going back to Netflix because actually it has all my preferences and all of that stuff. Or a better example, Amazon Prime. I know it's more expensive, but I get that predictability. I get that, that regular service.
And there's the irony, right? Banks have claimed to be customer-centric, have been trying to customer-centric for 20 years. But what they thought customer-centric meant was making it easier to interact with, as opposed to becoming a trusted custodian of the customer's financial life. It's quite a different standard.
Is this a giant misunderstanding? Because what we talked about the top is the experience layer and the bottom is all this customer data. And the way they're trying to keep the customer inside this jar is saying, I've got all your data and you've got to use this app and you can't get out of here.
Yeah.
And the customer's like, actually, I can. I'm just going to smash the glass and I'm going to be free. And I'm like, gone. But what you should be doing is what will keep me with you is if you have all my habits. And it's really hard to recreate a habit graph somewhere else.
And also, actually, the fact that you're a regulated institution means that that's a massive positive. Because I'm not going to hand my habits over to some random stranger who I don't know what the hell they're going to do with it. Yeah. And ironically, this is the competitive moat of the trusted regulated institution. And streaming into removing bad conduct, turn it into a huge virtue. We're the only people you can trust.
I mean, sticking with the UK, because you're based there, do you think that that's what is happening with, the digital banks? They're sort of like giving you a little bit more detail. I'll give you an example. Monzo gives me my year-end spend. It's kind of like my Spotify playlist in a summarized. It's just that the fact that my bank can do that is kind of encouraging. It's still far from where I'd love it to be.
Yeah.
But do you think this is the advantage that digital banks have over incumbent banks?
But only because, to your point, architecture at digital banks is a top table conversation. I don't think most incumbent banks, I don't think the CEOs and management teams of most incumbent banks view the architecture of their bank as the top, as an issue that the CEO cannot delegate. It's a bit complicated. Let's leave it to the IT department. We'll just tell them what we want. And it's like, you're missing it, right? What you're trying to do is get better at account management. That game is the past. The question is, how could you architect into being a customer data custodian? And that's not even a question you're asking, let alone an answer.
It's interesting you should say that, because no CIO or CTO from a bank has become the CEO. Interestingly, Mike Dargan, who I don't know if he was there when we worked at Standard Chartered at the same time. He was a CTO or CIO at UBS. He's just been hired not by UBS to be their CEO, but by N26. So he's going, I don't know many examples of CTOs who've gone on to become CEOs. Development,
But I think in the fintech world, as you say, that's not uncommon.
Yeah, Zubin and I talk a lot about this in our pod. We talk about an engineering mindset. And that's the point. It's a combination of what we just talked about. It's about having long-term vision. It's about sort of not being enamored by the glossy app layer, but actually going deeper and understanding how the software is built. It's what you talked about complementary of people like Piyush, etc., who went a few levels deeper than your classic CEO.
And one point I would make is it's not actually technical in an engineering sense. I think it's more logical than technical. I'm going to give an example. When I worked at Singtel, my boss was the CEO, and she actually had been the first employee of Singtel when it had been privatized from having been a civil service company in the mid-90s. And her point was, when she joined Singtel, they didn't have customers. They had subscribers. So people subscribed. That was the mindset of the institution. People subscribed to the phone network, and we run a phone network. Then a phone was called on-premises equipment. It was the extension of the network into your house, and so it was a technical thing apart. Right now, obviously, in order to phone somebody, what you needed to do was you needed to know their phone number. You needed to know their account in the network, effectively.
Yeah.
Well, then what happened sometime later on was Apple pointed out that people tend to phone people that they know. Why don't we create a thing called a contact list? And people can phone people from their contact list. And then other people came up with the idea of people tend to have relationships. So why don't we have networks and social networks? And the idea of phoning the account on the network left that telco industry years ago, but not because the telcos did it. It's because others did it to them. Well, I think the same is happening in banking. Just because I want to pay you, I shouldn't need to know your account number and your sort code.
This is a bit of difference sitting in Asia. I don't even know. I send money to all my friends, whether I'm in Singapore or in India, people in Thailand, you name, the country, are sending money based on mobile phone numbers because of the national ID system, right? National rails exist. UPI in India, Pay Now here, Do It Pay in Malaysia. Everybody's sending money to each other on mobile phones. But that's not because the banks decided to do it. It's because the regulators stepped in and pushed that, which brings me to my question. What is the role of a regulator in this sort of, mix? Because clearly banks haven't done it. Do regulators push it?
Yeah, and it's really hard, isn't it? Because do they try to push it from a sort of a conduct and customer agenda, or do they try and push it from a liberalization and competitive agenda? The Apple Wallet is a great example of that challenge, right? Which is the Apple Wallet is developing its potential because of open banking regimes. So it was a competitive thing that's driving the potential for customers to probably get, not yet, probably get a whole range of financial management tools from Apple that they should have got from the bank years ago.
Yeah.
So, but if that happens, and then, as I say, the trusted custodianship that could otherwise have happened, that the regulators could have said, the great thing about the banks is that people in banks can break the law if they don't do KYC right, if they don't do credit assessments fairly, if they don't, and that's a good thing. It's not just for the banks, but for the industry. It's a good thing that there are people who consumers can trust. So I'm hoping it's a conduct-based transformation, that actually they're pushed into taking this custodianship out of obligations on conduct, not about fear of competition. But I think everything at the moment is the reverse.
I'll share with you maybe a controversial view for European listeners here, possibly the US, but definitely European. The challenge with open banking is that it's a descriptive kind of approach to openness. What we've seen in Asia is a prescriptive measure, prescriptive in like, this is how the phone number will be rendered. Sure. This is how you will, these are the sort of the limits that will be allowed. That prescriptive approach has allowed for industry to sort of come together. It's sort of like the USB-C moment. Europe's been very good at pushing USB-C onto Apple, but it hasn't really told its banks, you're going to have to do it this way. It's interesting. I don't know.
And I definitely agree with that. And I think that's definitely is the criticism. To your point, to two examples of the obvious, the reverse, isn't it? One is barcodes. What a genius that was to say the best way to make supply chains interoperable is by a series of black and white lines, have standard meaning for everybody. And secondly, the internet, of course, the TCP/IP protocols, and we're not gonna try and wire the world together. We're just gonna create a standard language for packets of data, and the world will wire itself. And that was a genius that unlocked innovation. And you're right, interoperability standards is a much more effective way of unleashing competition.
And interestingly, banks banks kind of push back on that, but it's actually in their advantage, because if you leave it to the long arc of time, what will happen in the West, quote unquote, is that stable coins and CBDCs and other things will sort of take over, and you'll lose control, of that, because they're essentially being run by private companies right now.
Yeah. And maybe this comes back to the point you made a while ago about tenure, leadership tenure, which is if the dominant part of your tenure is spent preserving what you have rather than creating what's possible, you spend more time focused on keeping customers on your platform, making the platform more efficient, as you say, pursuing bad profits than asking the question, what role can I play in this digital future of our customers, embracing the technology that's coming? Or do I just outsource all of that and I just drift into being the dumb balance sheet in the future of the industry?
Yeah, and it's I don't think they're deliberately doing this, but they're sort of slowly driving down this cul-de-sac, particularly in Europe, but around the world as well, ex-Asia, I'd say, to a large extent.
Yeah. And I would just want to say, so we can go doom and gloom. I would also say that in every financial institution that I've ever had anything to do with, and I think you'd say the same, there are passionate people who are passionately in that industry to try and make the lives of their customers better. And the book is as much a blueprint for them as a how-to guide of how to bring together customer architecture and leadership to make that, as it is to be a doom and gloom merchant about saying, you're irrelevant and the world is moving on without you.
Who have you written this for? Have you written it for CEOs, CXOs, middle-level managers?
Yeah, I do think there are lots of people who are either healthy money champions or healthy money curious in most financial institutions. And I think for that, it's probably more for them, partly to argue a how-to guide as to how they would do that and what kind of conversations they need to have, but also hopefully to help them recruit a broader group of executives around them to saying, actually, why are we focused on customer inertia rather than customer engagement? Why can't we do other things? So it's a how-to and a recruitment.
And so Alistair, I thought we could play a little game before we, wrap this up.
Okay.
It's sort of like healthy money bingo, if you like. Let me sort of explain the rules of the game to you. I'm just making this up on the fly, so let's see how we do with it. Your book is about three, not primitives, but three sort of core capabilities that you think people need to develop: architecture, customers, and leadership, right? The sort of the levers you talk about. I'd love to understand what advice you have for the C-suite at the top, the middle managers, and at the bottom, people who are starting out their careers. You've got you've got kids who are going to be in the workforce, hopefully soon. Maybe they'll choose banking.
Right.
But what advice you have for them? So does that work for you?
Okay. Well, I think overall, probably the advice that all of those layers is to take a perspective on each of those three topics.
Yeah. So let's go with the CXOs. Let's start top of the house, go through each of those three topics and then go down.
Yeah.
Does that work for you?
Okay. So at the top, the first thing I would say on architecture is it's vital that the CXO recognize that architecture is something they can't delegate. So the layered reusability of the architecture is a thing that they need to focus on.
So layered reusability.
The layers and the reusable layers.
So what about CXOs, the C-suite for customers?
Well, building for modern financial lives. That's the crucial thing, is build for the financial lives of the customers that you actually have, not the customers you had 20, 30 years.
I love it. By the way, I've got to confess to you, pause for a second. I think about this, whenever I think about modern lives, I think about Phil Dunphy from
exactly.
Families.
Well, the archetype modern family was one that I used with a board to describe.
If you ever make a movie out of this, you'll have to get him to play that role of the modern family head.
Absolutely.
Just rounding out C-suite, let's talk about leadership. What's the message for leadership?
Yeah. Okay. Well, the crucial thing there is customer engineering. It is engineering with the customer in mind. Both words are important, right? It's engineering. That's the C-suite has got to recognize that engineering is not something it delegates, but customer engineering is the way to cut through, not reusing the existing capabilities.
Beautiful. And that's what, I think Revolut and Monzo and all brought to the party.
Are really focused on that kind of stuff. Yeah.
So moving down to the middle management,
Yeah.
what do they need to think about when they think about architecture?
So architecture, to borrow a phrase I think from Google, steal with pride, i.e. this is about reusability. And reusability has two components. Me building stuff that you can reuse, but frankly, the more important stuff is me being willing to reuse your stuff rather than build my own. So steal with pride, make a virtue out of reuse.
I don't know if you remember this. At Standard Chartered, when we worked together, we had a program called FINTECH, but we paid people to copy each other's ideas. We had an award where if you came up with the idea, you got 3 points, but if you copied somebody's idea, you got 1 point or 2 points. And it was an incredible program. And I remember we said plagiarism is okay in this case.
And I think that's absolutely right, isn't it? That steal with pride is quite a powerful virtue, I think.
What about customers, middle managers and customers? What do they need?
It's about customer relevance and customer intimacy. It's about the jobs to be done. Can I focus on the unmet needs of customers' financial lives and focus on the jobs that they need to be done?
Got it. And finally, rounding that out for middle managers, leadership. What do they need to think about?
Well, leadership there is about reproducing the technology mindset of giving customers more for less. Ensure that every year I'm going to release a better version, a version 16, a version 17. I'm constantly
getting better.
More for less, more for less, more for less every year.
Yeah, got it. And now to the sort of the newbies, people who are joining, graduates or young professionals. What do they need to think about in terms of architecture?
Well, I mean, obviously, their ability to dictate the enterprise architecture is a bit limited day one. But one thing I think they could focus on is the two-in-the-box mindset, which is customer-oriented people and technology-oriented people coming together to solve problems together. So if your first job is in one of the front-end retail organizations, find some technology people to work with. If your job is in the technology and the coding engineering part, find some customer people to work with and bring together two in a box as many times as you can early in your career.
Wow, that's the first time I've heard that. Where's that from? Is that an Alistair Campbell special?
Well, I'd love to say so, but no, I heard it from DBS and a lot of the challenges they generated there. So and I hope that they made it up. Otherwise, they may have made it themselves. They may have stolen with pride. So
if you're a young professional, two in a box could be have multiple meanings.
Okay,
but let's talk about, speaking of customers, let's talk about customers. What do new employees need?
Yeah. So we talked middle management, jobs to be done. And I think at a more basic level, the first challenge is empathy, is actually being able to say, as a newbie, can I start with customer empathy? And the point is, when we started our careers, we hadn't had many of the life experiences that really cause financial stress. We hadn't had divorces or health shocks or loved ones with health shocks or losses of income and employment, things like that. Those are the moments when people's horizons massively narrow. And that in those moments, if you can empathize even before you've had them, you're on a path to being able to develop services that are financial life partner services.
Yeah, and I think that's beautifully said. It's healthy not just for the individual and the relationship, but it's also healthy for the financial organization. And then to finish this off, what's your leadership advice to young professionals in banking?
Own your career. That as we said earlier, that you will have lots of different employers through your career. You will have lots of different paths. Those non-linear career paths are an inevitability that you should choose to embrace and love and take advantage of, rather than try to mirror people further up your own organization and view it.
So what you're saying is, don't just look at the CEO or the chairman and draw inspiration.
Yeah. Well, I think that's it. And chart your path rather than theirs.
Super. Thank you, Alistair. Thanks for this.
Thank you very much.